pause for a second. Gold just pulled back from near record highs, and if you skim the headlines, you'd think the safe haven trade just died. They're wrong. Yes, spot gold slipped after strong U.S. jobs data. Yes, risk assets bounced. Yes, some traders took profits. On the surface, it looks clean and logical, like a story that wraps itself up neatly. But here's what most people missed. While price pulled back, the structure underneath it didn't break. Physical premiums stayed firm. Central banks didn't flinch. Futures positioning thinned just enough to release pressure without cracking the floor. That's not selling. That's a pressure valve opening. And if you're holding gold, stacking it, or even just watching this market, the next couple of weeks matter more than most people realize. This is the window that decides whether you're early or whether you become exit liquidity for someone who understood the pattern before you did. Your job isn't to predict the exact turn. It's to recognize the setup before the crowd agrees on a narrative. That's what we're doing today. I want to walk you through two mechanisms you'll see again and again, not just in gold, but in energy, credit, equities, everywhere capital moves in cycles. Let's get into it. Quick ask before we go further. If this kind of breakdown helps you stay ahead instead of reacting late, hit subscribe. The goal here is simple. Build a group that watches structure while everyone else argues about headlines. Drop a comment that says watching if gold is on your radar this week. Now, here's what just happened. Gold pushed into near record territory, depending on the contract and venue, somewhere in the high 2,900s. Then the data hit. U.S. jobless claims came in strong, growth signals firmed up, and geopolitical tension cooled as tariff threats softened under the new administration. On the surface, that's a classic risk-off unwind. Fear eases, gold dips, risk assets bounce. But that's just the surface. If this were real selling, the kind that actually ends trends, you would already see it in three places. First, physical premiums in Asia and the Middle East would be collapsing. Second, COMEX open interest would be plunging alongside price. Third, central banks would either turn loud in the other direction or show clear evidence of stepping back. None of that happened. Price fell. Structure didn't. Sit with that for a moment. At the same time, headlines were shouting that safe haven demand was fading. Institutions were doing something very different in the background. Goldman Sachs quietly upgraded its long-term gold outlook, pushing its 2026 target toward 5,400 an ounce. That tension, short-term pressure versus long-term accumulation, is exactly where we're sitting right now. So, let me name the first pattern, because once you see it, you'll never unsee it. I call it the pressure valve. Here's how it works. Gold rallies hard on macro fear. Geopolitics flare up. Currencies wobble. Debt dynamics get uncomfortable. Inflation scares resurface. Leverage builds. Futures positioning gets crowded. Premiums spike. Everyone leans the same way. Then something shifts. Not the underlying reason people bought gold in the first place. Just the intensity of the immediate fear. A tariff threat gets walked back. A data print comes in stronger than expected. A scary headline cools off. And then the valve opens. Leverage positions unwind, algorithms sell. Profit takers step aside. Price dips, sometimes sharply enough to scare people who bought late. But underneath that price move, something very different is happening. Physical buyers step in. Central banks keep accumulating. Long-duration capital absorbs the supply. The structure holds. This isn't a pipe bursting, it's steam being released, and that's healthy. A pressure valve reset clears out weak hands and over-leveraged positions without breaking the trend. It creates the conditions for the next leg by transferring supply from impatient money to patient money. That's what we just saw. Gold pulled back after strong U.S. data and easing geopolitical noise. Futures positioning thinned. Headlines declared the rally over. But physical premiums in Asia stayed flat to firm. COMEX open interest declined in a controlled way, not a waterfall. Central banks didn't make noise, which usually means continuation, not reversal. The valve opened, the pressure released. The floor absorbed it. This matters because if you don't understand the difference between price noise and structural damage, this is where you get shaken out. You see red candles, you feel that knot in your stomach, and you exit right into the hands of someone who understands what's actually happening. If you're a long-term holder or stacker, this is where conviction gets tested. Not blind conviction, but informed conviction. Can you sit through a pullback when the underlying demand hasn't disappeared? I'm not telling you to buy dips or hold forever. I'm showing you what to watch so you can tell whether the valve is working or whether the structure is actually cracking. Here's the tell. When the pressure valve is functioning, price drops, but open interest stabilizes or declines slowly. Physical premiums hold or even rise during the dip. The dollar can strengthen without gold collapsing. When it's not functioning, price and open interest plunge together. Physical premiums compress hard. Central bank demand goes quiet and the data confirms it. We're not in that second scenario. Not yet. And you'll see this pattern everywhere if you start looking for it. Oil in 2020, copper in 2016, even Bitcoin during its early institutional accumulation phase. The crowd panics during the release. We watch the structure. Now here's the part that separates noise from signal. If this were real distribution, the kind that actually ends bull markets, you wouldn't need to guess. You'd already know. That brings me to the second pattern. I call this one the forecast lag. This is subtle, but it's powerful. Big banks publish forecasts. They upgrade targets. They release glossy research notes. Retail reads them and thinks, okay, now it's safe. The smart money is bullish. That's backwards. By the time institutions publish upgrades, the structural shift already happened. These firms don't move slowly because they're dumb. They move slowly in public because they're already positioned in private. Central banks don't announce every purchase. Sovereign wealth funds don't broadcast accumulation. Long-duration capital doesn't issue press releases. They act first. Then the narrative follows. You're seeing that play out right now. Goldman upgrades long-term targets while headlines talk about fading demand. JP Morgan and Citi issue cautious short-term commentary while structural flows keep building underneath. That's not a contradiction. That's a lag. If you wait for forecasts to turn bullish, you're late. If you wait for headlines to confirm the move, you're exit liquidity. But if you watch flows instead of forecasts, you see the shift before the story catches up. Flows are physical premiums, import and export data, central bank purchase schedules, vault movements, COMEX delivery versus paper contracts, ETF inflows, but more importantly, who the buyer actually is. Retail ETF buying is not the same as institutional accumulation. Paper positioning is not the same as physical delivery. Short-term speculation is not the same as long-duration hedging. Forecasts describe what already happened. Flows hint at what's coming. And right now, the flows are telling a very different story than the headlines. This doesn't mean forecasts can't be wrong, or that structure can't break. This isn't a guarantee. It's a framework. What matters is how price action interacts with underlying demand. If price keeps falling and flows reverse, premiums compress, open interest collapses, and central bank data confirms a slowdown, then the structure is breaking. But if price dips, flows hold, and forecasts quietly creep higher in the background, that's the lag. That's where the edge lives. This is where retail usually gets shaken out. So let's slow it down and make it concrete. Imagine you're holding gold right now. You bought near 12,800, maybe lower. You watched it run toward 12,950. You felt good about it. Then the pullback hits. Not a crash, but enough to sting. Now you're asking the question everyone asks. Is this the start of a reversal or just a healthy reset? Most people look at price to answer that. That's the mistake. Price is the output. It's the scoreboard. It tells you what happened, not why it happened or what's likely next. Structure lives underneath price. When gold pulls back after a strong rally, one of three things happens. In the first scenario, leverage unwinds, physical demand absorbs the dip, and the trend resets at a higher level. Futures positioning thins, open interest stabilizes, premiums hold. That's the pressure valve working. In the second scenario, leverage unwinds and physical demand steps back slightly. Price drifts lower without panic. Premiums compress slowly. Open interest declines steadily. That's distribution, but not collapse. It's a caution zone. In the third scenario, leverage collapses, physical demand vanishes, and the structure breaks. Open interest plunges, premiums crater, central banks step back, and the data confirms it. That's capitulation. Right now, we're between the first and second scenarios. The valve opened, positioning thinned, the physical bid held. The question is whether that bid stays firm or quietly fades. And this is how you track it. Watch the spread between paper and physical. If futures are soft, but physical premiums in Asia and the Middle East stay firm, that's real demand absorbing speculative selling. Watch open interest relative to price. Falling open interest with stable price is healthy. Falling open interest with accelerating downside is not. Watch how gold responds to dollar strength. If the dollar firms and gold barely budges, gold is transitioning from a risk-off trade to a structural asset. We're testing that transition right now. Gold pulled back after strong data. Risk assets bounced. The dollar didn't collapse, but gold didn't break. That's not proof the rally continues. It's proof the structure hasn't cracked yet. If this pattern breaks, everything changes. So, here's what you need to sit with. The real question isn't whether you should buy or sell gold. The question is whether the floor is real. If this pullback is the pressure valve doing its job, the structure holds, and the next leg sets up. If physical demand fades and premiums compress, then this isn't a reset. It's the early stage of distribution. We don't know yet, but we will, and the signals will tell us, probably sooner than most people expect. So, here's what I'm watching this week and why it matters. First, COMEX open interest. A slow decline with stable price means leverage is leaving without panic. A sharp collapse with falling price means forced liquidation. Second, physical premiums in Asia and the Middle East. Flat or rising premiums during a dip mean real buyers are stepping in. Fast compression means demand is stepping back. Third, dollar strength versus gold's response. If the dollar firms and gold holds, that's structural strength. If the dollar spikes and gold collapses, the safe haven bid is unwinding. Fourth, central bank behavior. Silence during pullbacks usually means continuation. Verified reports of slowing purchases are the real warning sign. That's where entities like the People's Bank of China and the Reserve Bank of India matter more than headlines. Fifth, risk asset behavior. If equities rally and gold doesn't crater, diversification is happening. If stocks rip and gold dumps, risk on is back in control. Watch how gold behaves relative to markets like the S&P 500. As for what I'm doing, not advice, just approach. I'm keeping position sizes reasonable, respecting volatility, knowing my exits if structure breaks, planning scenarios instead of predictions, staying patient, and watching alongside a community that compares notes instead of reacting alone. Let me bring this home. Gold pulled back after strong data and easing fear. Headlines say the trade is over. The structure says something else. Price fell, structure didn't. This looks like a pressure valve, not a reversal. It looks like a forecast lag, not a failed thesis. Your edge isn't calling the bottom or top. It's knowing the difference between noise and a structural break. If you're watching flows instead of headlines, you're already ahead of most participants. You're not reacting, you're interpreting. And that's the edge. So drop a comment and tell me which signal you're watching most closely this week. Open interest, physical premiums, dollar strength, central bank activity. If you've lived through cycles like 2011, 2016, or 2020, share what you learned. Those lessons matter. Markets don't turn when fear peaks. They turn when pressure quietly releases and patient money absorbs what scared money dumps. The valve just opened. Now we watch.